So what I'm going to talk about is, the topic says quantifying your business risk, but there are some things that need to be said before we get to that particular issue. And in the interest of time, I will basically just, there are 2 or so slides that I really want to focus on. A lot of the slides were leading slides. So, for example, this one, I won't spend much time on it. This is basically saying that small and medium-sized businesses have a history of failure, and we all know the statistics. Some of those stats were quoted today. But apart from not having enough capital, one of the reasons why small business fail, believe it or not, is poor risk management practices. I often liken the excitement that comes with some entrepreneurs, and I have had the privilege of talking to persons with business ideas. And sometimes when the excitement is there, it is so hard for you to say, but when you consider these things, it doesn't look like it's going to work. And so that's a kind of risk analysis and a little bit more than feasibility study. And to me, sometimes it's like persons being in love with the wedding day, not recognizing that there's a real life to live after that. It's not just the idea of being in business, but the reality of what it requires and the risks involved many times are not properly analyzed until it's too late. So basically this slide is just setting the context that one of the root causes of failures in small and medium-sized businesses is just not paying attention to the risks, either before startup and even after the business. I'm competing with somebody over there. All right, so what is risk? There are many definitions of risks in the world today, and in the interest of time, I will just paraphrase. So what you're looking at is a slide here that has 3 definitions from 3 basic sources. The headline statement from this slide is that risk is basically something that is likely to happen, and if it did happen, what would be the impact? That's essentially what he's saying. Also, implicit in the definition is that you can't truly understand what your risks are until you figure out what your objectives are. So the example that I like to give is that if I'm going to the airport and I need to get there, my objective is to get there by 6 o'clock. If while I'm on my way to the airport, I see a nicely dressed older lady going to church with a flat tire, and I estimate that it will take me 2 hours to help her, which would cause me to miss my flight, am I going to stop? I ain't going to stop. Because risk is anything that could cause you to miss your objective and ultimately having an impact that you don't want. Now, what I would do, I would call on my cell phone while I'm on my way to the airport, somebody that hopefully lives in the area, to help the lady. All right? So if you don't truly understand your objectives, your revenue targets, your expense ratios, you will make decisions that are good but not wise. You can do a good thing at a bad time. So I thought I would share a little bit about some of the problems that we have seen in the news. Being a risk person, I read the news, not just reading the face of the news, but also trying to get through what could have caused some of these problems. Again, we don't have time, but I'll just hit some of these. Number 1 was in the news, 20,000 liters of fuel disappeared from Sangster's International Airport. And they said the theft took place between like 12 noon and 4 o'clock. Now, you must understand that there are some pipes that run under the tarmac up to the aircraft. How do you do that in a few hours? The question is, because risk management is also about being proactive, not reactive. It's also about being a fire safety expert, not a firefighter. In other words, you always want to try and see the stuff that could go wrong and take the steps before they happen. And you won't catch everything. But with a good risk management framework, you should be looking ahead and making the adjustments. Now, you could get into the whys and wherefores of how that could happen, but it just highlights that something went wrong. Jamaica Public Service in the news came out a couple of days ago saying that the auditors reported that they will not meet, or they've failed their loan covenants tests. In other words, they have these loans to pay and the banks require that they meet certain ratios. They failed to meet them and the auditors reported it. That's not good news. And the article goes on, JPS giving all the reasons. Number 3, small and medium-sized business. Small and medium-sized business in Montego Bay. A couple of days ago, the entire bicycle repair shop was burnt to the ground. $3 million. And I've described some of the impacts there. And I want to use this, not insured, right? Now I want to use this number 3 as a little backdrop as I race through some of the things that we can do to avoid being caught, for want of a better word, with some of what has happened there. So the question is, what business are you in? Do you have similar things that are about to explode that you don't know about? And how can you respond? If we had more time, I would walk you through these, but you'll get this presentation. This slide seeks to capture some of the common pitfalls that small and medium-sized businesses face. And so what I'm going to wind the presentation down with is some of the things that you can do to make sure that you're not caught off guard with some of these things. Probably worth mentioning number 3, fraud risks. Small and medium-sized businesses often suffer from theft. There's a study that was done that shows that every time a fraud takes place, you need at least 2 conditions. 1, you need the opportunity. You need some loophole in the system. And then 2, you need somebody who has some pressure in their life. So maybe they had a bad medical report. They need $2 million to do the operation. This person was always handling cash in your business and never thought about stealing. The opportunity came because the controls are weak. The pressure came because of the bad medical report. And before you know it, you're down $3 million and maybe the business has to close. The next one is opportunity plus attitude. I've been working in this business for all my life and I can't even afford a 10-year-old car. Again, the staff will use that to take advantage of opportunities in the business. So what I'm going to try and do in my 4 minutes is to just show very quickly how we can go about identifying equivalent things and some things that we can do to make sure that we don't, or at least reduce the chances of getting into situations like these. And we're going to use this simple case study with a bicycle repair shop as a backdrop. I handed out a piece of paper with the actual newspaper report. You can Google it. So the background is that $3 million in losses. A fire happened. They weren't insured. A lot of young people from the Montego Bay area used to come by this shop. A lot of them, no matter the known riders that we have, this is where they got their practice. So you can see the impact of this business going down is very high. So the first thing that we need to do in quantifying our risk, because you can't quantify what you don't understand, what you don't know exists. And I made this point earlier. You must understand what it is that you're trying to achieve. So strategically, if you're in business, you want to make money, you want to satisfy your customers, you want to employ you to have a good experience, and you want your reputation to be intact. And you have to sit down and brainstorm with your team members, what are some of the things that could adversely affect those things? And believe me, those things exist. We just don't really think about them. What are some of the actual losses that you've had in the business? 2 years ago, you had a small fire, never got the whole business. Is that something to learn from? You had a near miss. Your GCT returns fell behind so far, you almost got a penalty, but you begged and you didn't get it. That could have caused the company to go out of business. So the risk, this is really answering the question, where do I find the things that could adversely affect the big ticket items that I'm trying to achieve? Actual loss experiences, near misses, seeing what happened to other people in other industries. So the checkpoint here is, for the bicycle repair shop, did they fully understand the risk of fire? Now, the newspaper article didn't get into how the fire started. But should they have seen that maybe there were electrical wires, if that was the cause, that were about to start a fire and did something about it? We don't know. But the fact is, the fire happened, the business is gone. Number 2, not everything that can go wrong is equally important. And this is where you have to do what they call a risk assessment. And pretty much what that is ranking the things that could go wrong in some order of priority. But for you to do that, you need what they call an objective way of saying this is high risk, this is medium risk, this is low risk. And that's what they call the risk criteria. So if something is highly likely to happen and it would have a massive impact, that's going to be high risk. If it is not likely to happen, would have a low impact, you don't need to worry about it. Because everything that is high impact, highly likely to happen, you're going to need some money to make sure that they don't happen. Okay? So number 3 says, what is my appetite for risk? I'm going to run out of time. What's my appetite for risk?